Well, good day to everyone who has joined us in such impressively large numbers from all over the world. I am Stuart MacDonald, and I'm moderating this, which is the second of the Distributed Ledger Technology, or DLT, and Crypto Assets Investment Experts Aaro Capital's Thought Leadership series of educational webinars. These are designed in a thoughtful way for investment professionals to learn more about this fast-growing, often complex, and fast-maturing space, still often, understandably, misunderstood, and the exciting investment opportunities that it obviously presents. There is an increasing amount of serious interest from serious investors ranging from Fidelity to Paul Tudor Jones in this space. And Aaro Capital is, to my knowledge, the first player with a truly and authentically institutional quality multi-manager approach to it. This approach is very research driven, and this is reflected in Aaro's use of advisors like Dr. Spyros Galanis of the Department of Economics at City University of London. And Spyros will be the first of our speakers in this webinar. He's going to talk about the economics of DLT and crypto assets. And then we'll hear from Ankush, Jain, Chief Investment Officer at Aaro Capital. He's one of the founders there, and he'll be talking about the challenges in constructing a professionally managed DLT and crypto assets portfolio. I'll just, by way of housekeeping, talk about a couple things for all the participants. If you have any questions, please put them into the chat room that you'll see on your screen, center right on your screen. And clearly, if time limitations prevent us from addressing all of your questions now, please get in touch and Aaro will answer them offline. Also, the presentations being used will be available to download via the handouts section that you'll see on the center right of your screens. Well, time is pressing, so Spyros, over to you.
Thank you very much, Stuart. So I'm going to go right through it. So I'm going to talk about the economic aspects of DLT, the distributed ledger technology, and crypto assets. So the plan of the talk is to talk about 4 topics. So the first one is what is DLT? So what is a distributed ledger technology? And I'm going to give some definitions. Then I'm going to talk about DLT governance. So how do we govern these projects and what are good characteristics of governance? Then I'm going to talk about the crypto assets, so cryptocurrencies and tokens, and give a very brief overview of that. And then I want to make the argument here that DLT and crypto assets are very closely linked. So you cannot have one without the other. And the last part, which is going to be the most important part of the talk, is to talk about the economic benefits of DLT. So what problems do we solve with DLT, and essentially where is the value of DLT projects from an economic perspective? Okay, so just to have some basics. So a database, let's start with the basics. So a database is a structured set of digital information. There are 2 dimensions that we can compare databases. So one is in the dimension of control. So who controls the database? So if we talk about centralized databases, then it means that there's only one entity that has read and write permissions and controls everything about it. If we go to the other extreme, we talk about the decentralized database, which is controlled by multiple entities, so that ownership and governance is shared. And we can also have something in between. In the other dimension, which we call the dimension of execution structure, is the question of where the data is stored. So in a centralized database, the data is stored in a single location. In decentralized, you have multiple centers, multiple local centers, and you have multiple copies of the data. And then in the distributed is even more to the extreme, where the data is stored in multiple nodes, and every node, and that's the important thing here, is autonomous and independent. And so you have a peer-to-peer network. where all the nodes are created equal. Now, there are many pros and cons. If there's more time at the end, I can delve more into that aspect. But if you talk about centralized databases, then you have the highest transaction speed and volume because you have data in one location and controlled by one entity. On the other hand, they are more prone to attacks because there's a single point of failure. On the other hand, distributed databases are more resilient to outside attacks as there is no single point of failure. But at the same time, they're less scalable in terms of transaction speed and volume. Now, what is a ledger? So a ledger is just a database. So it's another name for a database, but we usually talk about a ledger if it's a database of financial information, right? So a distributed ledger is a distributed database that is immutable and read-only. A blockchain, on the other hand, is a sort of a special type of a DLT, where the way this is happening is that you have a series of blocks, and whenever you have new information you want to put in the database, you just create a new block, and this is appended in the series of blocks, right? And this is how you implement immutability and read-only. Now, the important innovation here is that the way we're able to implement it centralized design is by having tools from cryptography and game theory. And I'm going to talk more about this later. Okay, so now let's talk about DLT governance, right? So traditionally, whenever you want to govern a project or a firm or a government, then it's usually a centralized type of structure. At the end of the day, you have somebody who's going to make the decision. Here, you want to implement a decentralized structure because you have all of these independent nodes that need to come into a consensus so that the project moves forward. So I'm going to talk about 4 principles of good governance for these projects. So the first one is obviously decentralization is one of the reasons why these projects and why DLT has been invented and implemented. So you want the database or the ledger to be stored, maintained, updated, and governed by many independent nodes. And as we said, there are these pros and cons that I have already mentioned. One of the main advantages of decentralized governance is that you're not reliant on a trusted intermediary. You don't have a third party, maybe he's the owner of the network or somebody outside of it that you need to trust so that this operation can continue, right? So that's one of the main differences from centralized databases. The second good characteristic of DLT governance is transparency, right? So because you have all of these independent nodes, if you need for decentralization to work, you need to have some aspects of the decision-making process to be transparent. So I need to know what's going on, how decisions are being made, and also I need to understand how the transactions within the network are being processed. And this is one of the big advantages of DLT because, for example, if we talk about public blockchains, transactions are recorded on a distributed ledger and can be accessed by anyone, right? So there is a public nature to that. On the other hand, if you talk about Bitcoin and Ethereum, a lot of the decisions are being made by consensus, and then all proposed changes are publicly observed. So they're first deposited in this platform, which are called BIP and EIP. Then they are discussed, and then there's a consensus, and we moved forward with the change. Okay, however, transparency does not solve the issue of authenticity of data input. So if you put in the blockchain, in the ledger, information that is false from the beginning, it does not mean that because you have transparency in the blockchain, this is going to be magically changed. But if the information is correct at the beginning, then you are very sure that this is not going to be manipulated later. The next element is security. So transactions should be secure from unauthorized access, and more importantly, be tamper-resistant, right? So that's a very important element for any type of a database. There are usually 3 different ways in which a database or a ledger can be compromised. So the first one is brute force attack. So you have an attacker from the outside. He makes multiple attacks. Eventually, he's able to breach through. The second one is software vulnerability. So there's some kind of an error in the code. and this is exploited by somebody. And the third one, which is actually the most common one, if we're looking at history of security breaches, is human or operation. So you have like a central administrator who makes a mistake. He presses the wrong button, and suddenly there's a problem, and the security is breached. So the ledgers, the DLTs, essentially minimize a lot of the human error. Why this is the case? Because they are designed to operate without a central administrator who can do anything he likes in the database, right? So there's an open source code which can be inspected by everyone, and you cannot change this without consensus by all of the members of the network, right? And at the same time, because you have a shared ownership, this means that you have a shared responsibility to uphold and to protect the database, right? So this gives also incentives to avoid mistakes. And there are specific protocols such as proof of work and proof of stake that are designed exactly to align incentives of the people who maintain the network and the database so that it's protected against attacks. Okay, the last part of good governance is accountability. So you want, in general, that stakeholders and users of a network or of a database know who is responsible for each of the network's functions, failures, and successes. So we know there's a lot of literature showing that there's a direct connection between accountability, ownership of tasks, and performance. So if you know that you're accountable for something, you're going to be performing better. Now, currently, there are no, in permissionless blockchains, there are no formal executive roles, and decisions are made through consensus, so there's collective responsibility rather than individual accountability. On the other hand, when you propose changes, as I said, through these platforms, changes for on coding, then you put your name forward. So essentially, you are responsible for the change of direction that you propose for a particular project. So there is some accountability. And moreover, now there are several projects, several DLT projects that have started implementing formal governance. And this is happening through voting tokens. So there are some proposals, then you have some tokens that you can use to vote, and therefore there's more accountability. Okay, so now let's go to the next part, which is about the crypto assets, right? So this is sort of a very brief overview of the different assets that can be issued through a DLT or a blockchain. And what I want to make clear here is the link between the crypto assets and DLT. Now, so for example, let's talk about cryptocurrencies. So what are the cryptocurrencies? The cryptocurrencies are designed to be a general means of payment for goods and services, right? So the aim or the ambition of Bitcoin is that they eventually can be used to buy goods, and it's already being used, but at the level of other fiat currencies as well. At the same time, though, the cryptocurrencies also act as an incentive and coordination mechanism in order to prevent attacks that aim to corrupt the ledger, essentially the blockchain on which the cryptocurrency is issued. And this is done through the proof of work and the proof of stake protocols, right? How does it work? Because if you are somebody who updates the ledger, then you are being rewarded using this cryptocurrency. So therefore, if the value of the network and the value of the cryptocurrency is high, then you have a higher incentive to protect the network from outside attacks. And this is one of the major innovations of DLT. At the same time, so essentially, if you have a cryptocurrency, it cannot exist outside distributed ledger technology, right? Because if it is not issued in a decentralized manner, if it is issued in a centralized database, then it just becomes a digital currency that, for example, could be issued by a central bank. And this is totally different from what the cryptocurrency does. Now, there are many different tokens, and so I'll just give you a brief overview of that. So, for example, you have, tokens are also issued in within a DLT. So you can have, for example, the utility tokens that are used to digitally access an application or service. You may have payment tokens, for example, to buy things in a decentralized app. You can also have security tokens that are connected to assets that exist outside of the blockchain. For example, they're connected with real estate or equity and so on. And there are also the voting tokens that, as I said, are used to provide governance in a particular project. Okay, so now we go to the last and the most important part, in my view. It's about the economic benefits of DLT and crypto assets, right? So what I tried to argue in the first part was that DLT essentially implements a different type of a data architecture, right? This has not been done before, and that's the innovation, because DLT implements a database that focuses on decentralization, shared ownership, and control of one's information. Okay, so if you're a user, then when you deposit your information in the network, you have much more control over it. At the same time, the design leverages economic incentives so that the DLT is protected against attacks. And it can also be self-governed because it can issue tokens which are voting tokens that you can use to govern the project, and at the same time incentivize participation. But the question now is what is the importance in terms of benefits, right? So why do we care, and where do we see the value of this from an economic point of view? So I'm going to talk briefly about three problems that we have, three economic problems, and how DLT can solve them. So the first one is essentially the problem with trusted intermediaries. So traditionally, whenever you have a database, for example, a ledger with financial information, the updating and maintaining records of the transactions could only be performed by trusted intermediaries, right? So when you have a bank, the bank has a ledger, and it tells you how much money you have. It guarantees that this money is sent to somebody else when you pay for something, and so on. So all of these transactions need the bank to verify the identities of everyone who is involved and to keep track of what's going on. The unintended consequence of this is that these trusted intermediaries obtain market power that they may abuse, or they can make even mistakes that will compromise the information of everyone. And the bigger economic problem is that the incentives of the owner of the network and the users are not always aligned. For example, the owner could alter the records without anyone realizing or being able to prove it. And this is also comes down to transparency as well. Okay, so how does the DLT solve that? The solution is decentralization, and this is one of the main reasons why the DLT projects are very interesting. In that case, ownership and governance are shared, which means that now there's less of a distinction between what is a user and what is the owner of a network. So all of the people can be both users and owners at the same time. So the incentives are more aligned. And this, in turn, promotes trust among users because everyone is sort of created more equal. This means that they can actually trust the network more, deposit more information, interact more, and therefore create more economic value than a situation where you have one trust intermediary and everyone else holds back because they don't know how this intermediary is going to behave in the future. The second problem is a very well-known problem in economics, which is called the holder problem. And this is defined as follows. So you can have two firms that enter a partnership, and for this partnership to work, there has to be an irreversible investment. So, for example, you have a hospital and an insurance company, and they invest together to harmonize their systems so they can share information with each other. The problem now is that after both firms have invested in this network, then it could be that one of the two firms have a stronger negotiating position. If they want, then they could leverage this position in order to alter the terms of the agreement and say to the weaker firm that now, for example, you're going to pay more money to us just to keep this connection. The weaker party now is locked in that partnership because if they want to exit this network, they have to incur another irreversible investment and join a different network. Because they are locked in and because the stronger party knows that, they can take advantage of them. But then if we talk about this in terms of a backward induction type of an argument, The weaker firm, if they anticipate this type of behavior, maybe they will not enter into the partnership in the first place, which means that there's going to be no cooperation and no economic value that's being created. So how does the DLT solve this issue? So we can alleviate this problem with the DLT because ownership of the network is shared. First, every firm has greater control over the information they deposit, so immediately they can withdraw consent and they can say to the other firm, you no longer have access to our information, because essentially the ownership is shared. It's not that the other firm controls fully the network. Through voting tokens, every user can be an owner, which means that any change of terms has to be through consensus, right? So it means that if you're a relatively small partner, you have some guarantees that the terms of trade are not going to change abruptly. And finally, there is this DLT essentially forces through this software standardization, because it creates a system that is standard among different firms, which means that a firm is more easily able to exit the network and join another one, and this creates competition. So essentially, it reduces the bargaining power of the stronger party. So the last problem is what we call the chicken and egg problem, and this is a problem about how networks evolve and grow. So we know that the value of a network is always how many people are there with how many people you can interact, right? So the first person in a network essentially sees no value because he cannot interact with anybody else. But at the same time, he creates some positive externality to the second player, to the second user, right? Because the second user comes in and now he can interact with the first user. So the early users, the early adopters, and the people who create essentially the value for the network create some positive externality, but that they do not internalize this externality. So they're not getting rewarded if the network becomes successful. But then if they do not get rewarded, then they will not join in the first place. The only way that they do is that there is a mechanism that is going to reward them if the network is successful. And this happens traditionally by providing ownership, property rights to the early adopters, right? So the person who is going to build the network, for example, by paying developers to create the apps or by incentivizing users to join the network, is going to have property rights over the network, and therefore, if it is successful, he's going to be rewarded in the end. But then we go back to the issue of centralization, because then this individual or this firm is going to completely own the network, and therefore they can manipulate the power, they can abuse their power and change the terms at a later date. So for example, with Facebook, when it first started, there was a pledge that it will only be a network about university students. But obviously this changed when the network proliferated and grew, and this was not necessarily something that the initial university students would have liked to do in the first place. How do we solve this? Well, one way is to solve it through tokens, right? So you issue tokens in the network in a DLT project that is earned by everyone who is a participant, either a user, a developer, or an investor. And for example, you're a developer and you do some contributions, you get some tokens. If the network is successful, then the price of the tokens is going to increase. So the holders of these tokens are going to be rewarded. So in that way, the positive externality of your participation is internalized. So you're getting rewarded if the network is successful. And at the same time, and this is the important thing here, is that there's no need to grant property rights to one particular investor. So everyone, through this shared ownership, is an owner. Everyone is going to mutually benefit if the network becomes successful. And at the same time, if these tokens are, for example, voting tokens, you have a say on how this project is governed in the future, right? So again, you don't run into the problem of having one entity that is going to change the terms of how this project operates in the future. So this incentivizes participation and engagement, and actually creates more economic value, because if you know that you can be rewarded, you're more likely to actually participate in the end. Okay, so the last slide I want to talk about, coming back to the initial question that I had. So where is the fundamental value of a DLT project, right? So there are many projects that are called blockchain projects or DLT projects, and when you're trying to find where the value is, I think you can sort of get into two sources. So the first one is the immediate benefit from digitization. For example, you have a trade finance project where everything is paper-based. If you make it digital, then probably you're going to drive a lot of efficiencies. However, these efficiencies and this benefit can also be driven by more centralized platforms. So in that sense, the fact that you call it a blockchain or a DLT project does not mean that you actually get any of these benefits. The second is what is important, and this is about economic benefits that stem from the unique characteristics of DLT, which is shared ownership, decentralization, tamper-proofness, and so on. And so therefore, when you evaluate DLT projects, you have to look at where the value is coming from, right? Because if it is from the second source, then you can be sure that the DLT project actually delivers value over and above the first source, which is the digitization. Okay, so with that, I finished my presentation.
No, well, thank you, Spyros. Very interesting points, and some really interesting questions have come out of that. I've been advised that the chat hasn't been working so far, and we'll try and rectify this, and I'll encourage participants in this webinar to put questions for Ankush, our next speaker, into the chat as he goes along. But I've actually been fed a couple questions that are evidently from participants, actually 3 of them. We may have time just to focus on one at this stage, Spyros.
Okay.
And they are, what is the difference between proof of work and proof of stake? Something that really does interest me, I like this one. What are the pros and cons of centralized versus decentralized ledgers? And equally, have there been any, you talked about tamper-proof, but I mean, have there been any notable security breaches of blockchains in the past? I don't know, maybe just very quickly address the question of what are the pros and cons of centralized versus decentralized ledgers? Because I know there's competition in a sense between the two.
Yes, thanks for this question. So just very briefly, so centralized ledgers, the pros are that they have the highest transaction speed and volume of transactions, right? So they can generate a lot of transactions, they can update very easily and very quickly. The problem is that they're less robust to attacks, right? Because there is single point of failure, either because the data is stored in a particular location or because they are controlled by a single entity, right? If they're controlled by a single entity and this entity, for whatever reason, makes a mistake, then they can be breached, right? And another con is that the governance relies on trust intermediary, right? So if you enter this centralized database, the question is, do you trust the person who controls that he's going to be, he's not going to abuse their power and they will not make any mistakes. On the other hand, if you're talking about decentralized ledgers, they are more resilient to attacks. There are multiple independent nodes, both in terms of where the data is stored, but also how they're governed, because all of these nodes are independent. So even if one node is a malicious node, or even if he's making mistakes, this will not compromise the ledger. On the other hand, they are they're less scalable in terms of transaction speed and volume, right? But this is sort of a bottleneck that is being addressed over time as a technology progresses, right? Because we have to realize that the decentralized ledgers are a very new technology, right? Whereas the centralized database is a very old technology, has been developed a lot in the past.
Okay. I wish we had more time. I suspect that I'm sure you'll be participating in another of these webinars soon enough anyway. So look, thank you very much. And there may be further questions from participants towards the end. I think we should move towards Ankush, and for those of you who've joined us late, Ankush is the Chief Investment Officer of Aaro Capital, one of the founders of the firm. And until I met him and some of the other people involved, like many people, I used to think that blockchain was just a database and that crypto is no more than a slice of the Wild West, and an immature one at that, full of teenagers or whales who manipulated the whole thing. Clearly, the whole thing's moving forward very quickly and maturing. And as I mentioned earlier, serious institutional investors are beginning to come into the space, and the trading infrastructure is coming together. And certainly, I think if you want to take advantage of the investment opportunities while controlling the risk and also grabbing some of the diversification benefits that it offers, you could do worse than thinking in terms of the sort of approach that's embodied in what Ankush is going to talk about, which is really an institutional quality approach to the whole thing. Ankush, I'm going to hand over to you now, and hopefully we'll have some time for questions afterwards. I'll remind people that handouts will be available of the presentations used via the handout section, via the handout button that you can see center right of your screen. Also, please do ask questions via the chat. Over to you, Ankush.
Okay, thank you, Stuart, for the kind introduction, and thank you, Spyros, for talking us through the economics behind DLT and crypto assets. So I'm going to be following up on what Spyros is talking about and talk more about how to gain exposure to the space and the challenges that arise when trying to do so, which is particularly important given that there are hundreds, if not thousands, of funds and investment vehicles available in this space. But before I do that, I just want to put some focus on this quote. This is a quote by the master himself, Mr. Harry Markowitz, where he talks about diversification being the only free lunch in finance. It's a quote that stood the test of time over the past 70 years. And in the past, investors have typically diversified across equities, bonds, property, and other asset classes. But we reached a point where things are looking far more uncertain. So if you look at equities, equities are at all-time highs, driven by central banks and governments injecting more and more cash into economies. You have bond yields at historic lows to the point where high yield isn't even high yield anymore. And alternative assets like property, investment trusts, and hedge funds, which haven't done too badly given the circumstances, but they've struggled to provide the same diversification benefit that they've provided in the past. So all of this has naturally led investors to search for new ways to diversify their portfolios and even try and find alternatives to the traditional alternatives. So it's for this very reason why nearly 80% of institutional investors now find something appealing about digital assets. And the top three reasons for this, according to Fidelity, are that they're uncorrelated. So there's some clear diversification benefit through an allocation towards them. They're an innovative technology play accelerated by coronavirus developments. And also they're high potential upside, which is a plus for any investment portfolio. And on that note, we've seen many players such as Brevin Howard, Renaissance Technologies, the big man himself, Paul Tudor Jones, all publicly endorsing this space and making some quite sizable allocations. So to give a couple of examples, Paul Tudor Jones, he was talking about Bitcoin more from the macroeconomic perspective as an inflation hedge. Renaissance Technologies, Brevin Howard, more from the trading perspective. So they all have different viewpoints, and it's just a reflection of where we are in the growth and adoption life cycle currently. But where does the opportunity present itself? Well, within DLT, or the long-term blockchain-related opportunities, it is expected that there's over $3 trillion worth of value to be generated and created within this particular asset class. And this is expected to accrue across a number of different areas. So McKinsey outlined over 80 different use cases, from finance to healthcare and even art, where this technology can be employed. So there's huge potential in terms of where it can be applied and where the value can be accrued. And this has led many big companies to start focusing on this space. So you got companies like HSBC putting 10 billion worth of private placements onto R3's Corda blockchain. You've got UBS digitizing internal processes in terms of trade finance. JP Morgan with their JP Morgan Coin for the real-time transfer of payments, and even companies beyond the banking industry. So Amazon focusing on enterprise blockchain, Facebook with Libra, which has been quite a big story over the past couple of years, and MasterCard and PayPal both using this technology and also making it accessible to the general public. So MasterCard is making it easier for crypto companies to issue their own payment cards, and PayPal is allowing consumers to directly buy and sell crypto from their mobile phones. And just as a reminder for those of you who aren't so familiar with what we do here at Aaro Capital, part of our thesis is being able to get in front of these developments before other people do. Because what makes DLT so powerful as a story is the clear economic value that can be created through the adoption of this technology. That's what really makes it stand out relative to a lot of older, much more traditional asset classes. So at Aaro Capital, we try and understand which companies and sectors are employing this technology, explore where the value is accrued, and ultimately find the best vehicles to profit from these long-term developments in a safe and sustainable manner. But of course, DLT is not just about blockchain, it's about other related technologies. And of course, the world is becoming far more digital. We all know that coronavirus is accelerating the adoption of technology to the point where it's becoming fully integrated and perhaps unavoidable in our day-to-day lives. So the trust component is becoming more important, regardless of whether protocols are becoming centralized or decentralized. But on top of the DLT aspect, at Aaro Capital, we also focus on the short-term opportunities presented by crypto assets. So this can include cryptocurrencies, crypto commodities, and tokens. It's a space that's growing very quickly, but it's still immature and very volatile, and therefore the risk needs to be managed appropriately. But we can see here, even after adjusting for risk, the returns offered by crypto assets have been far above and beyond other asset classes, which is, again, a strong case for diversification. But the bigger story in terms of diversification is correlations. So you can see here the long-term correlations between crypto assets and other asset classes is virtually zero, which is ideal from a portfolio construction and diversification standpoint. So clearly there's an opportunity. There's an opportunity presented by DLT crypto assets. But as an investor, it's all well having a view and a thesis on why to invest in something. But the real challenge comes in being able to express your view and being able to find ways to gain exposure in a safe and sustainable way. And currently, the way things stand, none of the investable options are that easy. So, for example, on the DLT side, you can often try and gain pure play exposure to DLT by directly investing in companies and projects. We like to call it direct VC. But the issue here is accessibility. So the top deals are often crowded out by top VC firms and those with the more established networks. So actually gaining exposure is the difficulty in that regard. For those who want to go through the VC fund route, I mean, you can do that, but aside from being locked in for 7 to 10 years, the only exposure that you're gaining is to one side of the market. It's the equity side. And as Spyros pointed out earlier, the unique economics of this space means that the value can often accrue in tokens as well as the equity. So it is important to have perhaps a bit more of a broad approach when approaching that angle. And finally, for those who wish to gain a bit more of a retail exposure to DLT, you can do that through blockchain ETFs, which, mind you, are not the same as Bitcoin ETFs, which don't exist. Blockchain ETFs focus more on companies employing the technology and generating value from them. But unfortunately, many of these are very impure. So to give one example, this is the Reality Shares NASDAQ Next Gen Economy ETF. They select companies based on how many times they mention the word blockchain in analyst earning calls or annual reports. And as such, it has an extremely high correlation to US technology stocks. So you can see here, relative to the NASDAQ, correlations have been close to 1, which is quite impure when it comes to gaining blockchain exposure. On the flip side, if you think about crypto assets, Direct access is a bit easier. It has become easier as time has gone on. You can go out and buy Bitcoin, Ethereum through many different ways. However, understanding where the real value is being accrued, understanding the economics, that requires time and expertise. And of course, the operational challenges that come along the way are quite difficult. So in terms of storing assets, hacking, avoiding the temptation to transfer assets to Elon Musk or Bill Gates on Twitter when they try and send you a message about that. So there's a lot to bear in mind on the investment and operational front. Some of the operational challenges can be eased up by looking at Bitcoin funds, such as the ones offered by Grayscale or Pantera, some of the bigger names in the industry. However, with these, you're only really gaining exposure to one asset, which is Bitcoin, and it's such a huge investable universe and landscape. So, in essence, with a Bitcoin fund, you're paying a fee for just one asset, just one component of the overall market. For those who wish to diversify beyond Bitcoin, you can invest in a passive index, so a passive crypto index that offers exposure to other cryptocurrencies, other crypto assets. However, these are diversified only in name. So these are often rules-based, they're market cap weighted, they don't really keep up with the fast evolving nature of this particular sector. And as you can see here, just one example, the Bitwise 10, almost 90% of their assets are in Bitcoin and Ethereum. So you're not really getting diversified exposure to the wider industry. Even the indexes which are a bit more diversified, such as the CCI 30, because they are more diversified, they're also more volatile. So in this particular case, if you invested $100 in the CCI 30 at the start of 2018, by the end, you'd be left with just over 10. So in terms of a safe investment or something where you can put your money in and kind of forget about it, it's not great from an investment viewpoint. And the volatility is perhaps something that is a good justification for an active approach. So since 2018, if you look at this chart, active funds have notably outperformed passive funds, which is the opposite of what we've seen in the traditional markets. The returns have been positive rather than negative, and the outperformance has been above 130%. But if you look into the fine details, if you look a bit deeper into the root of that outperformance, well, the dispersion between underlying DLT and cryptoasset funds has been quite notable. So the worst performing fund since 2018 would have nearly lost all of your money, whereas the best performing one would have returned over 500%. So there's a huge amount of dispersion when it comes to fund performance on the active side. But also in terms of the operational side, PwC published a report once a year, which is roughly consistent with what we find at Aaro Capital. So in terms of fund size, AUMs, whilst many funds have reached capacity at 50 or over 100 million, we have seen others on our radar that are much, much smaller. So there are some differences in terms of size. On the custody side, 20% of funds still don't have a custodian. So they're still self-custodying, storing their own assets, which does present some risk to investors. And the ones that are custodying, so the ones that do have a custodian, many of them work with unregulated custodians, which again presents some counterparty risk. In terms of valuations, a few years ago, many crypto funds would self-report their valuations to investors, given that it's a 24/7 market and there are some difficulties in accurately valuing assets. There has been some improvement with administrators now independently verifying and reconciling valuations, but there is some clear dispersion as funds continue to make that transition. And then finally, in terms of governments, only 40% of funds have an independent director on their board, which is important in terms of oversight and keeping on track with operational setup. So again, there are some differences in funds in that respect. So on the operational side, there's also a lot to think about, despite the space evolving over the past couple of years. So we've covered reasons for gaining exposure, the challenges that come along the way, And then finally, we can talk about how to construct a portfolio. The first thing to note is that unlike a traditional fund due diligence, where you're dealing with established firms and perhaps the investment side is a bit more important, in the DLT and crypto asset fund space, you have to place an equal amount of focus on both the operational side in addition to the investment side. So this is due to its unique and nascent characteristics, which are quite different from the traditional fund landscape. And this also feeds into risk management. So you have to focus on risk from the very early stages. If you look at this little diagram here, in terms of investor risk, this is all about understanding where DLT and crypto assets fit within your portfolio. We covered manager risk in terms of the investment side, the operational side. Portfolio risk, is this all about bringing this all together, diversifying across different funds and strategies, and managing things in a way where you can rotate between underlying investments depending on where the risk is in the market. So all these things have to be in mind when making decisions. And also, one thing to bear in mind, that there are risks in a traditional sense, but there are also some that are specific to this particular market. So hacking risk, exchange risk, crypto custodian risk, and even niche ones that are a bit more related to the underlying technology, like denial of service attacks and honeypot risk. Quite a funny term there. Also, when it comes to diversification, as pointed out earlier, diversification is the only free lunch in finance, and the same holds true here. So at Aaro Capital, we look at the long-term picture in DLT, as well as the short-term inefficiencies and opportunities presented by crypto assets. And there are many different ways to gain exposure to this, to those two different areas. You have market-neutral approaches, very low risk, low return, offering fairly stable returns regardless of market movements. You also have long-short funds that carry a bit more investment risk, but much higher return potential. And they can also be a bit more secure on the operational front by trading futures or hedging their bets in certain ways. You have opportunistic funds, a bit more crypto-specific. They can be engaging in mining, lending, staking. And you also have longer-term fundamental plays, much more thesis-driven and playing into the longer-term DLT story. So individually, these strategies offer exposure to various subsets of the market, and in combination through diversification, they form a much more balanced picture when it comes to gaining exposure to the space. Finally, the focus of this webinar, economics. So understanding the economics is incredibly important in this market. It is a very diverse market that can only really be understood by digging into where value is being created and where profits are being generated. But once you understand those two key things, you can also identify where, which type of funds and vehicles are best placed to capture the trends. And also, once you've constructed a portfolio, you need to be able to rotate between positions and understand which positions are going to generate more value depending on the macroeconomic environment. So having all of this in your mind and combining all of this thinking into a diversified risk managed approach is what really makes a difference, and is perhaps where you need more of a specialist in this particular market. So on that note, I'd like to thank you all for listening. I'll hand over back to Stuart, and happy to answer any questions that you may have.
Well, thanks, Ankush. And like it or not, there are questions. That was really interesting. I'll just point out to participants that Aaro has produced a series of quite in-depth thought leadership white papers and shorter pieces about different aspects of DLT and crypto assets, and it would be well worth going to the Aaro Capital website where you can gain access to those papers. Very well written, a lot of them, and there is one being published even today. But some questions that have come to me, and I'm sorry if the chat isn't visible to everyone, in no particular order. One is, how do managers engage in fundamental analysis in this space? Surely that's impossible. That's one. Another is, which of your four buckets, the ones you were speaking about just now, which of the four strategy buckets do you think will perform best? And associated with that, how can you actually identify that the market is either bullish or bearish? Because it's pretty opaque to a lot of people who are not involved in it. Another separate line of questioning is, how is due diligence different here from, say, engaging in due diligence with a traditional hedge fund? Another question is, why is diversification important in this market? Why isn't Bitcoin, enough? Really up to you which one you start with. We've probably got time to answer a couple of these at reasonable length.
Yeah, sure. Sorry, what was the first question?
Yeah, how do managers engage in fundamental analysis in this space? I could also associate with that, how can you identify, whether the market's in a bullish or a bearish phase?
Yeah. Okay. Yeah, that's quite a good question, because unlike the traditional markets, there aren't any established valuation models like the DCF approach or transaction multiples, comparables, and so on. So engaging in fundamental analysis is quite different. There's no strict criteria when it comes to looking at companies or projects. On the DLT side, a lot of the long-term fundamental funds that we've come across, they tend to focus more on themes, or they have a thesis about the market when it comes to investments. So for them, it's again, it's more about understanding the economics and understanding where projects and companies fit within the wider macroeconomy. And also understanding where the value is being accrued. So which segments of companies are best placed to implement DLTs as opposed to traditional databases. So for them, it's more about long-term economic thinking rather than very strict valuation-driven approaches. And on the crypto asset side, again, looking at prices is very difficult. And although many people have tried, there is no real valuation model. You can often look at on-chain metrics to analyze the health or network effects present in an underlying protocol. Part of that's because adoption somewhat leads to increased value. So yeah, I mean, there's no hard and fast rule when it comes to valuations, and it's more driven by what's happening on the technology level, what's happening in terms of economics. And if you are interested in learning a bit more, we have a few papers on how to engage in fundamental analysis, how their economic value is derived from the space. So yeah, happy to go into a bit more detail afterwards if you want to drop me a line with some more questions. And also, I think another question was, following on from that, how do you identify if the market is bullish or bearish? Again, another good question, because lots of people try and predict where the market is going, which is very difficult in any circumstance. At Aaro Capital, we've done quite a bit of analysis on this. So we have our own methods to identify generally where the market is going. Based on our research, technical indicators are extremely short-term, and they're not quite as useful when it comes to making longer-term strategic decisions. But they are useful to have in your back pocket. On-chain metrics have a bit more significance. So again, it's all about understanding what's happening at the network level, what's happening with underlying protocols. And I think out of all the metrics that we've seen, minor fees are probably one of the best indicators, alongside network values to transaction values. And I think finally, alongside the technical indicators, on-chain metrics, having a general macroeconomic viewpoint, knowing what's happening in the markets, and understanding the wider context of where things fit in, allows you to be a bit more proactive and act more on those developments. So it does provide some context in terms of whether the market is bullish or bearish.
Okay. Let's go to an obvious question. I mean, why is diversification important, and why couldn't you just play this all out through Bitcoin?
Yeah. I understand why the question has been asked, because Bitcoin size means that it covers 60 to 65% of the crypto asset market at the moment. But the reality is that Bitcoin doesn't reflect all of the opportunities currently available. And in the same way, you wouldn't allocate all your capital to US equities because they're 60% of the market. You shouldn't really do the same with Bitcoin. So if you look at the investable universe, there are hundreds, if not thousands, of crypto assets. A lot of DLT opportunities that extend beyond blockchain, and developments happening pretty much every day. So a lot to bear in mind, but it just shows you the scope of the entire universe. And it isn't just a Bitcoin story. It's a much longer term story with a lot of short-term opportunities along the way. And to give you an example, even this year, there's been a clear divergence between holding just Bitcoin and the returns available in the rest of the market. In July alone, Bitcoin is roughly flat. Other tokens and crypto assets are up about 5%, and public blockchain stocks are surprisingly up the most, and they're up 10%. So there are some clear opportunities aside from Bitcoin, and provided that you can manage the risk along the way, you should be compensated with returns in that respect. So to answer your question, diversification is extremely important in the same way that it's important in pretty much every other market.
Okay, but something that you spent some time on, due diligence. How is this different from the way in which you'd conduct it with other spaces? For example, what's the difference between this and looking at a traditional hedge fund?
Yeah, I think the best way to talk you through this would be to talk about what I looked at when I was at a traditional fund of funds. So I previously worked at another outfit where I was looking at equity funds, fixed income funds, property funds, and so on. And our universe was thousands of funds across these different areas. The very start of our process, in terms of filtering and conducting due diligence, was filtering based on size. So the funds had to be at least 100 million in size, and also length of track record. So track records had to be at least 3 years. And then from there, we did a bit more detailed analysis on ranking returns, seeing how the fund would fit within our portfolio, looking at the investment process, and so on. So the investment side was far more important as opposed to the operational side. And in fact, I'd say about 90% of the process was doing analysis on returns and risks. And then the final 10% was just a tick box exercise. So looking at the ODD side and just ticking things off. This space is quite different. Number one, because track records are extremely short. So you can't apply the same 3-year filter in this space. Fund sizes are also incredibly dispersed. And we've seen some of the smaller funds actually showing a bit more promise than the larger ones. So yeah, you have to approach things more from the ground up. So sourcing funds through closed networks as opposed to established databases, having an equal focus on operational side of things as opposed to investment, and also looking at risk much more closely, given that this is a new market and is much more intricate compared to other markets. To summarize my answer to your question, it's partly to do with the nature of the space. It's much more complex and much more intricate, which requires a specialist approach when it comes to doing due diligence. And part of it's also, the fact that even within the space, there's a lot of dispersion and a lot of differences in approaches.
Okay, brilliant. We are pretty much bang on time, so unfortunately, I've got to wrap this second thought leadership webinar up. To those of you who are interested in pursuing this further, there is, the next webinar from Aaro is going to be in August, and there are more planned for the Northern Hemisphere autumn or fall, depending on your language. That was really interesting, Ankush. More questions out there, of course. And sorry we didn't have time to cover everything with you, Spyros, but I'm sure you'll be on one of the forthcoming webinars anyway. To all of you who have participated, thank you. If you are interested in finding out more, there are contact details on the slide to your left, and handouts are available. They should be available to you via the handouts section, center right of the screen. Otherwise, please get in touch, and to look into the white papers from Aaro and the other thought pieces. Look at their website. That was really, really interesting. And there was one question left unanswered. Very cheeky of someone to ask, what strategies do you think will work? Well, that would be telling you, wouldn't it? Anyway, thanks to everyone, not least our speakers, but also the audience for this, and look forward to the next time. Take care, everyone.